The Positive Theory of Capital by Eugen von Bohm-Bawerk. Book 7. The Rate of Interest. Chapter 3. The Rate in Market Transactions, continued. But our task is not yet finished. Following the same lines as we took in developing the general law of the price of goods, we must attempt to lay down the concrete determinants which decide the degree of productiveness of the last extension, and from our knowledge of these we must, in particular, try to get an explanation of the variations to which the interest rate is subject in practical life, sometimes rising, sometimes falling, but with a constant tendency in the latter direction, over the whole field of economical development in historical times. This analysis, too, will give us a welcome opportunity of verifying our abstract theory by experience. If we find that our theory, starting with certain assumed conditions of fact, leads us, of internal necessity, to expect just that movement of interest, which in the experience of practical life and history we see actually and always taking place when these conditions are realized, we shall be justified in taking it is a strong guarantee that our theory, although it uses such abstract machinery in the stating, is no vain imagining, but a theory obtained from the study of practical life. Moreover, in what follows I shall be in much less marked opposition to old doctrines than I have been in the foregoing chapters. For certain connections between the rate of interest on the one side and the definite facts on the other are so distinctly and unquestionably given by experience that it was impossible for the adherents of any interest theory, however erroneous, to overlook them; and however different the theoretical points from which they may have started, they find themselves at one in recognizing these. All the same, I venture to hope that what follows will give more accuracy and definiteness, as well as a new and more adequate explanation to many a proposition long accredited by experience. Following the line of inquiry already pursued, I shall try to investigate the concrete determinants of the rate of interest and the manner of their working, in such a way that we can successively vary the individual assumptions in our illustrative scheme, and then see what result the variation gives us as regards the formation of the interest rate. Let us look first, then, at the influence of the amount of the National Subsistence Fund. Assume that, other circumstances remaining unchanged, the available subsistence fund amounts not to 1,500,000,000, but to 2,400,000,000. The repetition of the same calculation as made above leads us to the conclusion that the equilibrium of the market cannot now be obtained otherwise than by 8 years' production period, a £60 rate of wages, and a corresponding interest rate of 3.54%. It shows that where the rate of wages is £60, the rate of productivity being given, the undertaker finds an 8 years' production period the most profitable; that 4.16 laborers may be employed by £1,000 of capital, and therefore 10,000,000 of laborers by 2,400,000,000; and finally, that this relatively most profitable method of production yields 3.54% interest on the undertaker's capital. As compared with the earlier ones, this rate shows a considerable decline, the reason of which is very easily explained. When the subsistence fund is increased, men can only keep it fully employed by entering on further extensions of the production period, which extensions are accompanied by steadily decreasing surplus returns. Indeed, the surplus return of the last extension of production economically possible from 7 to 8 years is only 30s, and the surplus return of the first non-permissible extension from 8 to 9 years is only 20s, and since the rise of the year's wage from £50 to £60 requires, for the 1 year's extension, not a capital of £25, but a capital of £30 per man. The marginal limits for the interest rates are 30s on £30 as upper limit, and 20s on £30 as lower limit. As a fact, the agio of 3.54%, which we found empirically, falls between these determining marginal limits. Assume conversely that the available subsistence fund amounts only to £1,000,000,000. The equilibrium, as will be seen from Table 4, is attained at a rate of wage of £42 and an agio of 19.048%. This is accompanied by some interesting circumstances which will repay a moment's attention, as they may be often enough realized in practical life, although not seen there in their full abstract purity. At a prevailing wage of £42, as it happens, two different production periods of 4 and 5 years respectively are equally profitable, and pay 19.048% interest on the capital invested in them. The result of this is that neither of them economically shuts out the other. Both may be adopted simultaneously, indeed, not only may but must, to keep the equilibrium. If the 4 years period alone were adopted, only £840 million of capital would find employment at a wage of £42. If again the 5 years period were exclusively adopted, the existing capital would employ only 9,524,000 laborers, and in either case the unemployed elements would, as we know, disturb the equilibrium by overbidding and underbidding. The equilibrium can only be found if the two equally profitable methods of production are engaged in simultaneously, when 7,619,000 laborers will be employed by a capital of £800 million in 5 years' production, and 2,381,000 laborers by a capital of £200 million in 4 years' production. And in virtue of this peculiarity, the latitude allowed in fixing the agio by the valuations of the marginal pair will be much more sharply limited in this than in the former examples. The last economically permissible extension of production is from 4 to 5 years, which brings in a surplus return of £4, that being a surplus on £21, half the year's wage. But, as it happens, the first excluded extension of production is also that from 4 to 5 years, inasmuch as shown above, the existing capital allows only a portion of the producers to take the 5 years production period. Consequently, the surplus return of the first excluded process, that which forms the lower limit of interest, is also fixed at £4. The upper and lower limit therefore coincide, and the interest must be determined strictly at the rate of £4 on £21, that is, at 19.048%, just as actually shown in our former scheme. Now the agio here is considerably higher than in the former cases, and our theory again explains it quite simply. The reason is that the diminished subsistence fund allows only a comparatively short processes on the average, and consequently the last extension of production, that which decides the interest rate, falls in a sphere where any extension of the production periods is attended by very considerable surplus returns. So much for the effect of an alteration in the amount of the subsistence fund. We have still to follow the effect of alteration in number of workers. Any detailed calculation here, however, should not be necessary. It does not require much consideration to see that a change in the number of laborers must exert its influence on the rate of interest in exactly the opposite direction. Whether, for example, the number of laborers remains steady at 10,000,000 and the subsistence fund contracts from 1,500,000,000 to 1,000,000,000, or whether the subsistence fund remains at 1,500,000,000 and the laborers increase from 10,000,000 to 1,500,000,000. In either case, the subsistence fund is just sufficient to employ the existing laborers partly in 4, partly in 5 years periods, while the last and decisive surplus return is £4 on £21, and the resultant rate is 19.048%. And it is as clear that if subsistence and laborers vary simultaneously in the same direction, say that both increase, the variations will weaken the efficiency of both, and the final movement of the rate will follow that direction taken by the stronger of the varying factors, and that on the other hand, if both factors vary not only in the same direction, but also in the same ratio, the rate will remain unchanged. Suppose, for instance, that the number of workers and the amount of subsistence fund both double. It is evident that the doubled fund will be sufficient to provide for the doubled numbers over the same production periods as before, and that the last and decisive surplus, and with it the interest rate, will remain unchanged. If, again, the fund were to double while the numbers increased only by a half, it is obvious that, on the average, a longer production period could be adopted than formerly, in which case the decisive last surplus return would be reduced to a lower point on the descending scale of surpluses, and the interest rate would also fall. Finally, we might inquire on the same lines what will be the effect of an alteration in a third factor, the state of productivity, assuming that subsistence fund and number of laborers remain constant. Here also we may spare ourselves any detailed tabular statement, It does not require any exact calculation to prove that if, other circumstances remaining unchanged, the scale of surplus returns constantly, shows higher figures. The surplus return yielded by the last extension of production that is economically permissible, that which decides the interest rate, must be higher, and vice versa. Say that subsistence fund and number of laborers stand in such a relation as to permit of an average 5 years production period, the interest will be higher if the extension of the production period from 4 to 5 years is attended by a surplus return of £6 as against £4, or of £4 against £1. We have then over the sphere of our investigation so far to record three elements or factors which act as decisive determinants of the rate of interest: the amount of the rational subsistence fund, the number of workers provided for by it, and the degree of productivity in extending the production periods; and the way in which these three factors affect the rate may be put as follows. In a community, interest would be high in proportion as the national subsistence fund is low, and the number of laborers employed by the same is great, and as the surplus returns connected with any further extensions of the production period continue high. Conversely, interest will be low the greater the subsistence fund, the fewer the laborers, and the quicker the fall of the surplus returns. This is the way in which the interest rate should be formed, and the way in which it should alter, if our theory is correct. How is it in actual life? Exactly as our formula predicts, and thus experience gives that formula the most complete verification. For first, it is one of the best accredited and recognized facts of economic history, that the increase of the subsistence fund, or, to use an expression not quite so accurate, but yet roughly significant, the increase of the community's capital, has a tendency to depress the rate of interest. Second, it is no less familiar and less evident that here we do not speak of the absolute amount of the national capital, but of the relation between that capital and the numbers of the population. In other words, we mean that an increase of population without a simultaneous increase of capital has a tendency to raise the interest rate. And thirdly, it is also an acknowledged empirical fact that the discovery of new and more productive methods of production, outlets, business opportunities, etc., which conduce to check the fall of surplus returns, tend to raise the rate of interest, while the closing of former opportunities of production or sale, or other occurrences which end in a reduction of the previous degree of productiveness, tend to lower the interest rate. We find, therefore, that all those factors to which, on the lines of our former inquiry, we were forced to ascribe a decisive influence on the interest rate, do as a fact possess and exert that influence. And now it is time to give, one by one, the features and forms of actual life to our abstract scheme.